Okay, in this problem we're going to use the effective interest method instead of the straight line method for amortization. So it looks like we're issuing a $500,000 bond, but we're receiving more. So we have what we call a premium, and the carrying amount is the amount that we received, which is $532,896. So to calculate the cash payments for interest, you always use the face value, which is 500,000, and you're going to use the stated rate, not the market rate. So it's these three numbers here. The 500,000 times 0.1525 times, and then we're not going to do for 10 years. We're just doing interest for 6 months. So times 6 out of 12. So the total cash we're going to pay is $38,125. Now to calculate the actual interest expense that we're going to have, we're going to use the market rate times the carrying amount. So we're going to do 532,896 times the market rate, which is 0.14 times 6 out of 12. And we're going to round this to the nearest dollar, so $37,302. So the difference between the cash paid and the actual interest expense will be the premium we're amortizing. So take 38,125 minus 37,302, and we're going to amortize $823 of premium. So this number needs to go down. We're trying to get the carrying amount to the actual 500,000. So we're going to subtract 532,896 minus 823, and we're going to get 532,73. Now for the next year, for the cash paid, it will still be 38,125 because this doesn't change. But for the interest expense, now you're going to use the new carrying value, and you're going to times it by the market rate, and times that by 6 out of 12 months. So this time it's going to be 37,245. So the difference between 38,125 minus 37,245 would be 880. So we're going to subtract the carrying amount, subtract the premium we're amortizing, and now we're down to 531,193. And okay, so I forgot to round up to 303, so that's going to change that. 38,125 minus 37,303 is going to be 822. So that's going to throw this number off by 1, and then which throws everything else off except for these numbers. So we have to do 532,74 times 0.14 times 6 out of 12, and that would be 37,245 right here. And the difference between those two numbers, 38,125 minus 37,245, is 880. And then I think that would just be $1 off. So rounding can really throw you off if you forget. I forgot to round up on this one. Okay, so now we need to journalize the issuance of the bonds when we received cash of $532,896, and the bond payable was $500,000. So we have a premium. The premium is a credit balance. And this is to issue bonds at a premium. Now the semi-annual interest amount and amortization of the bond, that's your journal entry where you debit interest expense and you're going to debit premium because you're reducing the amount of the premium. So you're amortizing it. And then you're going to credit cash. So we know the interest expense was $37,303 and amortization was $822. $37,303 and $822, and the actual cash paid is the $38,125. So this is to pay the semi-annual interest and to amortize the premium. And then journalize the payment of the second semi-annual. So interest expense, premium, cash. Now, the cash is still going to be $38,125. And the interest expense, I think, was $37,245. And the premium for the second year was $880. And this is to pay semi-annual interest and amortize the premium. And that is all of the problem on effective interest method of amortization. So to review one more time, with this one, you're to calculate the cash paid, you're going to calculate it just like we did on the other problems. You're going to take the $500,000 times the coupon rate of the bond times the semi-annual, which is 6 out of 12. And so this number will always be, you always credit cash for that amount. But for interest expense, it's different here. You're going to take the carrying amount and times it by the market rate of 14% to get the interest expense. So the difference between these is your premium. So premium is a plug. And then you're trying to get this number down to 500,000, and eventually when we get to the end of the bond, it will be amortized where the carrying amount is down to 500,000. So we're gonna, for the next year to get interest expense, we're going to take the new carrying amount and times it by the 14%, and that's how we get interest expense. And to get the premium, it is the difference. And that is the way that you will work question 5 on your homework.